Hi, I'm Quill at the Institute of Trading and Portfolio Management. I'm in Washington, DC today to interview David Perlin, who's one of our newer senior trading mentors at the Institute. Now, David's been in the finance industry for around 30 years. He's been involved on both the buy side and the sell side at various firms, hedge funds, investment managers, and investment banks. At the height of his career, he was actually a managing director at Goldman Sachs and headed up the International Trading and Sales Division in New York. He's also had the opportunity to mentor many different traders over his career. And actually, he was one of the mentors to our very own managing partner, Anton Quill, in the early 2000s. So this is a fantastic opportunity to sit down with David, discuss the financial markets and his career thus far and where he's headed. So David, it's great to be here in DC with you.
Wonderful to have you here, Chris.
Excellent. Now, you've graciously invited us to your home to do this interview. A fantastic home it is too. So thank you for taking the time out of your busy schedule to do that.
You're too kind. It's a humble abode.
So I think we should start off from the very beginning, really. It seems that when we take a look back at your career and your experience, that you've always had your sights set on a career in the finance industry. But that decision for you must have come about at some stage. So when was that and what made you want to pursue that path?
Yeah, it's hard to remember that I've thought about anything other than markets, but I grew up thinking I was going to be a doctor, physician, probably a surgeon. In fact, a funny anecdote, my mother was always dead set on me becoming a doctor, and when I pivoted to business, it was highly disappointing for her. So in 2000, when I made managing director, MD, at Goldman's, I called her and said, I'm finally an MD. So I had the last laugh. At any rate, in college, university, I pivoted to business. I decided that medicine wasn't going to be my career. So I went from taking a lot of science classes to taking a lot of business courses. And one of the things I realized, thinking I was going to be an accountant, quite frankly, I thought I was going to be a CPA. And what I realized was I was doing better in my finance and markets courses than I was doing in accounting. And then at some point during my time at New York University, at the time I think it was the big 8 accounting firms. Now I think they're big 3. So right, yeah. Consolidation. But I went to some sort of recruiting kind of social thing, and it was a room full of CPAs, and I quickly realized that really wasn't what I was kind of feeling, so to speak. And one of the great things about where New York University is situated is it's in downtown Manhattan. It's literally 2 subway stops from Wall Street. So I quickly pivoted to, I'm going to get a job on Wall Street. So this is, the early 80s. And it was wide open. And I figured out a way there. And that was the start of a long and largely happy journey.
Right. And how did you kind of kick off your professional career at that stage?
I actually used my accounting degree to get started. I joined a small trading operation. It was largely trading enough stocks to get IPO allocations. And that was a good business in the 80s and 90s. Not such a good business anymore. But the group that hired me to kind of reconcile books for like a 3-year period. Okay. That preceded my arrival. And I, in fact, found some money for them, which certainly paid for my very measly salary at the time. But by virtue of starting there, I started to learn about trading and markets and how IPOs worked. And more importantly was the networking benefit of being there, which was they were housed within a bigger brokerage firm. Not a big shop by any stretch of the imagination, but big enough. And I had an opportunity to apply for an assistant trading job on the bigger platform, and went from being kind of a support accounting kind of guy into being a frontline trading assistant, and really learned markets and how order flow works and how to speak market. So that was a very good opportunity. And through that job, my next progression within that same firm was to be a floor clerk on the New York Stock Exchange. As I jokingly say, that was when the New York Stock Exchange was actually an operating marketplace, not a TV set for CNBC, right. Or a kind of museum tour in New York. So it was cheek to jowl, real processing. Probably 85 to 90% of listed activity, market flow went through the New York Stock Exchange. So it was absolutely packed and absolutely busy. And that was yet another level of learning about stress, accuracy. I think I made a mistake my first day. Unfortunately, didn't lose too much money. And again, the power of the network was I met bigger firms and got hired by First Boston, which is now Credit Suisse, and became an upstairs, more professional trader than what I was destined to do just on the New York Stock Exchange.
Sure. And so how long were you at First Boston for?
About 8 years. And that coincided with a couple of things in the industry. At the time, we were the second player in program trading, which was really portfolio-based trading. Instead of individual names, you trade entire portfolio simultaneously or as quickly as possible. And that required, fairly, at the time, was, computing was a bunch of PCs strung together. But it was more advanced than other firms had. And we had the ability to trade, hundreds or thousands of different stocks at a concentrated amount of time. It was even possible at that time in the world, the financial futures market had just opened up, and we were able to do index arbitrage in the S&P, which is impossible now because of computers. There is no arbitrage opportunity in indexes. But we were able to buy, the 500 stocks between, 100 or so in NASDAQ and 400 in listed. And we were able to sell futures and capture a spread and make a return. And that was a fairly large proprietary book for us. And then we had a bunch of client portfolio trading opportunities and business. So I think we were the second entrant. Salomon Brothers was first. And we ended up running a pretty big business up until the crash of 1987. And the reason why it ended then was because program trading was blamed for about 95% of that crash.
Okay.
And not to admit anything that people don't expect or know, but we were pretty much accurately about 80% of the crash.
Really?
Yeah, because portfolio insurance at the time was a theory applied to actual portfolio investing, and it didn't work in stress, and it exacerbated the sell-off. And we wasn't the start of the crash, but it exacerbated the crash. So we wisely stopped doing that business, as did, I think, every other practitioner on Wall Street.
Yeah. I think it's interesting that risk models in general are always under scrutiny, and that seems to have happened since as well. Despite probably better risk models, we
look at the mortgage crisis and the liquidity crisis that ultimately engulfed banks and the financial markets. Previous to that, you could look at long-term capital management, which was a huge hedge fund that relied on really smart people doing high-level modeling and physics type of analysis that didn't work when things stopped, or when liquidity didn't, or when linkages didn't behave correctly. And the LTCM crash or correction was part of my Goldman days, and kind of watched that in the front row, so to speak.
Yeah.
I also joined Goldman International, I think 3 weeks before the Asian currency crisis. So one of the things that's really been a bellwether of having a long career in institutional trading, especially at some of the top firms, is kind of front row seat for a lot of things that went badly and why and what the lessons are.
Sure. That's something I wanted to get onto as well. So you joined Goldman in the mid-90s through to 2004, I believe. That was probably a very interesting time to be at Goldman Sachs, which was probably the leading investment bank on Wall Street at the time. Both from the perspective of what was happening in the financial markets with some of the events that you've just discussed, but also what was going on at Goldman itself. So why don't you tell us a little bit about how that period went for you at Goldman?
Yeah, it's interesting because I really purposely, because my career was going very well at First Boston, and we were busy, and I was a young guy, and I had a few accounts that really switched on for me, so I was doing really well, and they liked me, at least they told me so, and I was, starting to make a reasonable amount of money. So I said no to a bunch of calls, because you get calls when you're in those positions. But ultimately, Goldman called me, and I was like, well, that's a little bit different. And what was different from a person that was at a really good firm, First Boston was a really good firm, was this kind of Goldman mystique. And what was it about? Well, it was the last true partnership on Wall Street. And it had this sterling reputation. And they really didn't hire from outside. So the fact that you get a call, being an experienced person, even though I was still young, was flattering, because I knew they didn't hire people. In fact, it took about 10 months of conversations before I actually got hired, which was kind of excruciating, actually. But to a person, they were really impressive people. And I think the eye-opening difference was just the depth and breadth of expertise, that the people were just more prepared, more professional, and some of the smartest people I had worked with and met. And that was just kind of palpable. And not in an arrogant or, weird way. It was just kind of there. The other thing that I really got attracted to was they rewarded kind of the non-production strength of a person. And what I mean by that is a lot of places, First Boston included, they really cared about your bottom line. Kind of end of the day, that's what really mattered. And it wasn't really about how helpful you are as a citizen of the corporation. Are you a good mentor? Are you additive to the team? And Goldman had this very significant team orientation, which to this day persists. But it was extremely true when it was a partnership. And that really appealed to me, because that's how I'm wired. Sure. I had a feeling that would really support my ongoing success. And in fact, my ability to plug into that kind of environment and be a really effective leader, mentor, culture carrier, kind of these quintessential Goldman terms you hear, really appealed to me, because I think I was confident that would work for me, and it in fact did. So I felt at home pretty quickly. I was very warmly welcomed, and I was successful, in a fairly short ramp up.
Yeah.
No regrets from that decision. It's certainly to this day my best friends and some of my favorite memories of business were from that experience.
So David, you speak very fondly about that aspect of your career, your time at Goldman through the 90s and into the early 2000s. Is that something that you look back on as almost the height of your career?
Yeah, I mean, obviously I'm excited about my independent new business that I own and run, but as far as my institutional equity career, that was the most fantastic time possible. I was at the best firm in one of the most interesting trading desks, running giant risk, covering all the big accounts, hiring the best people we can find. And it was truly work hard, play hard. We had a great culture, we had camaraderie, we were out a lot. The firm was making so much money, and the markets were just so interesting. And globalization of the investment world was happening right at our fingertips. So as an example, I mean, we would trade. I was running international equities, so we would trade gigantic blocks of like BP And, you know, it would be Chris and Anton that would be making price with us in New York. It was very collaborative, and the risk book was absolutely ginormous. Billions of dollars of risk on every day. And our revenue run rate at peak, which, you know, I would assume was probably 99, 2000, was just what's attributable to U.S. accounts was like in the order of $200 million a year. It was such a big business. European equities was such a big business that we actually had this fun exercise at one of our offsites. And you know when life is good in a business when you're offsite for a specific division and a specific trading business
right.
is lights out beautiful. Like, you know, you're at a resort in Bath in the English countryside, taking over an entire hotel with meetings and dinners and carrying on. And one of the exercises at kind of the height of that market and where Goldman was in the market was a hypothetical layout of an IPO of just Goldman's European equity business and what it would fetch as a standalone business. It was so fun because it put like these numbers to this effort that were just as good as you're ever going to see in a financial trading business. So our business was so wonderful and so big. At the peak, my desk was responsible for approximately $200 million in annual revenues in US dollars. And that's just the international trading component with US investors.
Right.
And the international equity business, if you look at Asia and Europe, was in orders of magnitude of that. And it was really a coordinated global book and global effort. Consistency in coverage, great people, great risk management, and by virtue of being at Goldman, just being involved in all these wonderful financings, IPOs, global tranches, the most complex, most interesting equity issuances at the time. It was really a great place to be at the right time.
Did you notice much of a change from when it was a partnership to when Goldman went public in that time?
I did, and I think that's just natural. It probably would have changed just by size and scope of the company anyway. Mm-hmm. But the biggest change is you just can't be as patient if you're public. As a management team and as an organization, you have to perform quarterly. And as a partnership, you're not reporting to shareholders, you just have to please the partnership. And as long as they agree it's a good decision, they can be more patient and a little bit more humane, if you will. Sure. There were a lot of stories from the old days of the partnership of unique things the senior partners did for people that were either needed a favor or needed help or something special. And as a corporation, it's just not appropriate or possible. And it also manifests itself in the team building, whereas you can be real patient with forming a desk and forming a team and developing talent. And when you're public, you're in a little bit of a rush. So the team building is less patient, and the expectations of performance are higher. And the need to right-size your business all the time requires you to hire and fire more often. Okay. And that kind of changed, to me, that changed the culture, and that was inevitable.
And so you were there until 2004.
Yes.
You were a managing director at that point. It's interesting, there must have been something in the water at that point, I think, at Goldman, because that's the year Anton left as well. So what was it that made you leave at that point?
Well, I always had this itch that I wanted to scratch, which was to be on the buy side, to be a hedge fund partner. And I had toyed with the idea for some time. And it was coincidental to that opportunity presenting itself, or at least pursuing it more aggressively, was just this realization that I was a little bit exhausted in a corporate sense, not in a physical sense, but in an emotional sense of we really were ratcheting down our business, the size, the people, because the internet bubble had burst and it just rolled through the equity business. And at the time I was running international trading. So when you think about it, I'm running international in New York. So from a New York perspective, I'm running a peripheral market. I'm not running US shares. I'm not running, So it's like nice to have, not need to have. So I felt unduly pressured within the context of, if they had to fire 5 people this quarter, let's look at international before we look at US. I just felt a little picked on.
Okay.
And I don't think that's hypersensitive. I just think that was the reality. And
sure.
I kind of get it. It just wasn't pleasant. So all this effort of building a great team, I had to unwind it. And that coincided with, stock vesting. I was already an MD. And it was just a good time to give an entrepreneurial, hedge fund partnership opportunity a shot.
Okay, yeah. So at that time, when you left 2004, it was to help start up a hedge fund, which was Quill Capital.
Yes, sir.
Which was a long-short equity hedge fund.
Correct.
So what was it like building up a hedge fund from the early stages? So you guys managed to accumulate quite a bit of capital quite quickly, it seemed.
Yeah, it was funny because, you enter those kind of businesses thinking, this is going to be the last job of my life. I'm just going to kill it. I'm going to ton it.
Yeah.
And the math really works. Like, assets under management, performance, ownership of a business. You can do the math. Mm-hmm. As opposed to the sell side where, I'm hired, I get a base salary, and everything else is bonus, and that fluctuates dramatically. A lot of which I have no control over. Say my desk does great, I'm awesome, but Goldman itself had a horrible year. I'm not getting paid that much. In a hedge fund, you're all aligned.
Right? Sure.
Performance is up, assets are up, money's up, and we split a very big pot.
Yeah.
So that was really attractive to me. Really, the key was the 2 founding PMs had experience at other well-renowned hedge funds. And we got in front of the right kind of asset allocators. But we really had to start with just kind of friends and family raise and show operational process and a portfolio. And then the money came.
Sure.
Which I think is an interesting lesson on asset management.
Yeah.
When you're starting from scratch, even with 20 years of top-notch investment banking experience to that time, and similar to my partners, it still took, the world wanted to see us work together in a different business.
Sure.
Before they entrusted us with asset allocations, institutional allocations.
Yeah.
But we got there, and pretty quickly.
And from there, you took up various leadership style roles at different firms, back on the sell side mostly, for the next few years. And by this point in your career, and certainly in those years, in those leadership roles, you must have mentored a huge number of young traders coming up through the ranks. So what was the kind of philosophy or process you had in place for educating these young guys and getting the best out of them?
Yeah, I think I learned really how to mentor well running the desk at Goldman, because we had so many recruits straight out of university and MBAs that really didn't have proper market training before that. I mean, they have the basis of knowledge. They went to school for it, but they didn't know what the industry really was like, and they didn't know necessarily the way we wanted it done. So I really just repeated that throughout my career, which is to say, even today with Institute mentees, I'm teaching them as if they joined my desk right out of university, whether they're 50-year-olds or 25-year-olds, that there's a certain way to prepare for the market, and there's a certain way to risk manage, and there's a certain way to think about it. There's not one way to trade, but there's the preparation and mindset that's repeatable. And I brought that to all those various desks that I ended up running post Quill Capital, which is, high degree of integrity and effort, and try to find some fun in this, because it can be fun, and understand that it is real money, and you have to risk manage it. And that transcends everything I talk about and think about when I'm training people and when I discuss what I do for a living, and,
Sure.
and the way even my business now is set up.
Yeah.
But it really is that. It's that consistent approach to giving people the basic kind of preparation and mindset to be repeatedly successful.
Yeah, yeah. It would be interesting to hear your thoughts in a little bit as well about how that applies to the retail landscape that you're now involved in as well, retail traders. But before we do get onto that, the final piece in the puzzle really in terms of your career before we get to where you are now is that you moved back to Goldman Sachs, this time in the wealth management division.
Yes.
Which, the way I see it, seems like it would have been a little bit of a different role from the previous posts you held at various institutions and hedge funds or whatever, in the sense that you were probably now, when you're managing high net worth client money, thinking about investing more in a longer time frame.
Absolutely.
So
Yeah.
did your sort of perspective of financial markets or how you had to trade that change from previously?
Tremendously. I still approach the markets with a consistent risk management approach, but you got to remember that on every given day of a trading desk, I'm thinking about the risk management opportunity for that day, or what might persist more than that day. But so much of it is turn and churn. So if Anton has got a big position on in London, by virtue of something I did with a client in New York, in a London listed equity, we're going to share that risk and discuss it. But that's really it's a very minute focus within the context of time, because we're usually going to deal with that fairly quickly. And what I do now, I have to think about it in 3, 6, 12, 24-month kind of horizons. And if I'm doing non-traditional asset classes, private equity, venture, et cetera, we're talking 7, 8, 10-year kind of horizons in some of these investments. And that requires a different approach. Even though the day-to-day on a trading desk is that immediate, we're all invested. We make money and we put money in the market, and you can't really trade on Wall Street because of the restrictions and the holding periods. So you at least you're starting to think about your own money in a longer term horizon, and the kind of multiplying effect of being patient. But this transition's really forced me to have a longer lens, and quite frankly, I trade a little bit less now as a result, but that's appropriate for the market I'm in. And quite frankly, I'd probably still be, running a desk somewhere, either buy or sell side, if I happen to still be in New York.
Yeah.
In DC, not a lot of options for that. Just adjust to the market. In the market, there's plenty of high net worth.
Yeah.
And clients are everywhere.
Yeah.
I have clients in Florida and New York and here.
So that investment sort of style that you had at Goldman Sachs in the wealth management division has obviously carried over into Pearl Investment Partners, which is where you are today, what you do. So that's kind of the culmination, if you like, of all this experience that you've gained throughout your career. So what was it like? What made you want to start your own firm? And what are the sort of goals that you see for Pearl Investment Partners?
Well, one of the things I realized was when I pivoted to fit financial services into my DC life, was that wealth management was kind of a logical option and strategy and approach. And I didn't really look at many firms because I knew Goldman so well, and Goldman happens to have an office here. So it was an easy conversation to have, and a happy conversation to have. You know, welcome back to the firm. I left on good terms. I left as an MD. It's a different business, but, you know, same firm. And I didn't really, you know, I looked at JP Morgan, and I don't look anywhere else because I said, look, if I'm going to do this, I want it to be as similar as possible to my institutional experience. Like, I understand this is a retail business, but I think I rightly guessed or assumed that at Goldman and JP Morgan in particular, it's much more institutionally oriented. And when you talk about ultra high net worth, at least you have the ability to transact in some significant size, much like I did in my institutional equity past. And that appealed to me. So instead of amassing $100 or $200 million under management with 1,000 accounts, it just took 4 or 5.
Sure.
And that, again, that appealed to me. The transition to being independent was really a realization that the job that the big wealth management firms are asking me to do was not always what I wanted to do. And having already been a partner in a smaller, nimble financial services shop at Quill Capital, I was confident that I had an idea of what the risk and reward was of starting my own business.
Sure.
And what I really was trying to fix by creating my own firm was this realization that being an investor is not as important to the wealth management firms as being a good relationship salesman. And I don't mind having great relationships and trying to grow my business, but if that's 90% of what I'm being evaluated on, then I'm being underweighted on my investment prowess.
Yeah.
And I thought, well, I've been an investor my whole life and a markets guy my whole life. If I don't lever that, then I'm doing something wrong. Or at least I'm not really leveraging my abilities and my capacity. So that's really why I set my own firm. And I did that with a very candid conversation with some of my top clients, saying, I think an investment experience in an independent firm is better for you. Mm-hmm. And if it's better for you, it's going to be better for me. And here I am. So it's 2 years of managing money independently. I'm truly an investment office. I stay away from a lot of the multifamily office services. I don't do financial planning. I don't book trips. I don't bill pay. I don't walk dogs for people. I'm their investment advisor. I'm their investment officer. And that's what I'm focused on doing. Delivering a great portfolio, great reporting, very responsive, and always thinking about the portfolios.
And of course, since then, you've also become involved with the Institute by becoming a senior trading mentor. So how did that come about?
Well, it's hard to mentor when you have a small, nimble investment management firm. I don't have a training program of all these university kids coming through my office here in DC. So when I was kind of thinking about what a new firm or an independent firm could be, I happened to be in touch with Anton in just a casual way. And I was in New York for some meetings. And he said, mate, I'm coming through. I've got this super conference. Chris Caffey's coming, a couple other guys. I'm here with my wife. Why don't we grab lunch? And I'm like, that's awesome. And it was a beautiful day, kind of like what you see out our window. So we met up at a, typically a posh Anton spot for lunch in downtown Manhattan, and had some rosé and talked about life and business, and talked about what I was thinking about pivoting to and creating. And he said, have you ever thought about, what might would you do something else? You know, if I have, 6, 7, 8 great mentors, would you be interested in what we do? And I'd like to understand more about what that is.
Sure.
I think he knew instinctively that I understood what mentoring is and what it could be.
Right, yeah.
But obviously I didn't understand exactly how it was set up within the Institute. And we talked about it, and then I looked at it closer, and then I went to one of the vacation mentoring programs to check it out in person. That was in Florida a couple of years ago. And it was just the right timing, right opportunity. It's kind of surreal and gone full circle where, Anton was actually one of my mentees, at the beginning of his career in Goldman London. And I was in Goldman in New York as a senior trader. And, watching him develop very quickly. Quite frankly, he didn't need a lot of mentoring. But here we are 20 years later, and I'm a mentor in the Institute, and he's the, senior owner. It's an amazing journey, and a testament to the kind of relationships that we were able to build from those days. Yeah.
And since being at the Institute, you must have learned quite a bit about the retail trader landscape as well.
Absolutely.
Which would be a little bit different from the professional environment. But what do you think? There's plenty of things that carry over in terms of how you can mentor people and teach them to essentially grow into good traders?
Yeah, I think that there's a building block and an approach and an interest and an energy that has to be invested. And then I can teach the nuances below that. And what I mean by that is I'm going to give everybody kind of the building blocks of, obviously they're all taking the ITPM coursework, which you have some responsibility in how good that is. And migrating that knowledge into portfolio building and risk management and how to trade. And what I try to do is much like what I did in the heyday of Goldman. If I had new associates and new analysts, I try to get them as proximate to me as possible, and other senior people that were good at mentoring, and try to make it as real time as possible. So
right.
you take the education, all the coursework, all the training programs, and you make it visceral, you make it experiential. And we were able to, even in this environment, I'm able to explain complicated, fast-moving, market-moving ideas and trades on a real-time basis to my mentees, as if they were, 2 feet from me on a trading desk, and that's been really rewarding. And then you layer that in with kind of the one-on-one Skype sessions, where you're really teaching them how to take ideas researched or begun from the coursework and the PMIs and ISMs and roll that into a macro view down to a stock view. And then from the stock view, long, short, options, no options,
sure.
Stop losses, et cetera. So it's really kind of this funnel to getting to an operating portfolio. And it's been fascinating to see these guys kind of come into it and be almost like, oh my God, I'm drowning. It's too much. To,
sure.
Hey, I saw this, I'm thinking this, and here's the derivative idea of that. And in just a matter of weeks, getting kind of that brain synthesis of high level idea, applied fundamentals, some technicals to an implemented trade is really fascinating.
Yeah. And you've obviously mentored quite a few guys through the Institute now. What do you see in terms of the most kind of common mistakes that they make? Are the mistakes that retail traders make pretty similar to what you might have seen on a traditional trading floor in a professional environment?
They are similar. I mean, people make mistakes, buy, sell, limits. I'm like, there used to be a PBS TV show here in America called This Old House, and they were famous for measure twice, cut once. So if you had a board, if the board's supposed to go here, measure it twice, then cut it.
Right.
Because the first measurement's usually wrong or potentially wrong. So I tell people to say their order out loud so you don't get buy and sell mixed up or the volume. So the transactional mistakes are easy to avoid if you're careful. And
Sure.
You're careful by double checking before you say buy, sell. The other mistakes are over trading.
Right.
Because people get like happy feet and they're not committed. So getting people to trust a little bit of gut. Like, can I stick with this idea that I've been developing, even if price action is not immediately supportive of that. The other problem is once they kind of get going, some of them get a little too trade oriented and they don't do enough work. So they think they have it figured out, and then they overtrade like new names without enough preparation. And then that typically doesn't go well, and they go back to, being a little bit more deliberate.
Yeah.
So those are the biggest mistakes. I think the biggest growth is that progression from, David, I've got the macro, but I can't get down to the stock, and that takes a few sessions.
Sure.
And people come at it from different types of experience and different age and different education. But generally speaking, that's been the consistent challenge. People get started, they hire a mentor, they have some ideas, they've done the coursework, but they don't get the process to the specific idea and name.
Yeah.
And that takes some time. And I don't want them to rush. I want them to be comfortable and confident, because that'll inform their performance.
Sure. So we've talked a little bit about retail trader mistakes. Let's look at the other side of the coin now. So based on your experience mentoring some of the guys through the Institute, what's impressed you most about those guys that have graduated through our education?
Well, I think the biggest takeaway is that people are investing in themselves and in their lives and in their knowledge for their own empowerment, as opposed to, largely most of them aren't trying to get interviews at investment banks.
Right.
Some are, but most of them are just trying to be better with their own assets. And I think that's a really, wonderful goal. And it's something that they'll have forever. They'll have a prism or a view of what's real and what's not, what's important and what's not. And a risk management ability already being displayed that can be applied to any part of their lives, in their own businesses, and obviously their own retirement assets, et cetera. So what's eye-opening to me is that, I trained people that wanted to get better so that they get a higher bonus, and this was their career. Mostly my mentees, this is not their career, but it's a real interest, and they've taken that interest and invested in it, energy, money, attention, intention, and I think that's really aspirational and really cool, and I really enjoyed getting to know these guys.
Yeah, I think it's fantastic that guys can take ownership of the financial aspects of their life by going through our education. It's a really great thing to hear. Well, listen, it's been fantastic to sit down and do this interview with you today. Thank you again for taking the time to do this. It's great to have you on board at the Institute, massive asset to us, and it's great for all of the mentees as well that come through to have such a good mentor. So thanks again for joining the Institute, and I look forward to catching up with you again at another Institute event.
I do too, and it's been really, really fun to be part of the Institute and to reconnect with Anton and Chris and getting to know you and the other guys and helping people. It's been really rewarding. So I appreciate the opportunity as well.
Brilliant.
Thanks.
Cheers, David.
Thanks for visiting.
Thanks.